Well, Julian, you are going to tell us all about Meta this year. You always bring the heat with the international stock picks, and today you're looking at Meta's full year for 2023. How did they do?
Good night, everyone. So, Meta, formerly known as Facebook, has had a very strong financial year in the 2023. So, the company has grown its net profit after tax by 68.5% to 39.1 billion. And this has a lot to do with core growth in revenues of 15.7%. And beneath that, there is an increase in daily active users of about 8% to 3.2 billion users. So, for context, the company owns Instagram, WhatsApp, and Facebook, and the lion's share of the revenues from all these platforms come from advertising. And of course, the sale of data to third parties. Additionally, which the factor which supported growth in net profit after tax is an improvement in cost to income, which fell by about 70 basis points, which is significant. Now, the company over the last 3 financial years invested $92.3 billion, and all these figures are in US, in share buybacks, which would give the shares an upward bias, because what that does is take supply out of the market. So if a company is growing net profit after tax or earnings year over year over year, and there are less shares available on the market, it actually gives the stock upside because the supply of the stock is falling. So even if demand remains constant, it gives the stock an upward bias. Now, the company also invested 77.4 billion US in fixed assets, so that actually grows the operating capacity, and this excludes acquisition of other companies. And additionally, just to show the funding sustainability of the business, it generated 180 billion US over the same 3-year period in operating cash flows. So this limits the need for borrowing. So because the operating cash is sustainable and is much larger than expenditure, it means that the company has several options that it can explore, whether by growth in core projects by means of increasing its capacity in research and development, or buying back shares, or acquiring other businesses. Now, what's interesting is that Meta has paid its first dividend ever of $1.1 billion in cash to its Class A shareholders yesterday, and that produced some upside recently. So the stock is now trading very richly. It is actually up 2.7 times above its 52-week low, but it is down 5.3% from the 52-week high. Still, the stock is up 24% from the 50-day moving average and up 47% from the 200-day moving average. So it's a stock that is on the move, even though it is just below the high, the 52-week high. In terms of the valuation, it's trading at 31.5 times in terms of the PE, but the forward PE is expected to be 23 times. So that's significant. So the company is expected to grow earnings sustainably and bring down the PE in terms of the valuation. The return on equity is 28%, which is very high. But even though the company is doing well from a return on equity standpoint, i.e., it's performing well in terms of productivity, I still believe that the stock is trading richly. A more fair price probably would have been about $300. Right now, it is trading in the $400 range at $460, and that $300 would bring it closer to a 20 times PE. But of course, all of these significant developments around the company would bring a lot more momentum to the stock. I think that a cheaper area to look at is probably energy, probably like an ExxonMobil, because technology itself as a space is carrying a very high valuation. The NVIDIAs of the world, the Microsofts of the world. So energy is a good area to look at for cheapness and potential upside, not just from the price, because energy prices are likely to rise, in my opinion, in the next 12 months because of what's going on with shipping rates. And additionally, these companies that have more experience.
What's going on with shipping rates? What did I miss there?
So shipping rates are likely to rise because of what's happening in the Panama Canal. And of course, the Houthi rebels have been attacking a lot of vessels in the Red Sea corridor. So what that does is that it forces vessels to reroute, which increases how much energy ships have to spend to deliver the same goods to the same destinations. And
what's
also,
happening in Panama Canal? I feel like I'm behind. What's going on?
so there is actually drought conditions in the Panama Canal, which reduces the number of ships that can go through the canal and the volume, not just the number of ships, but the size of the ships. Because the shallower the water becomes, is the smaller the vessels have to be to pass through it, because larger vessels require deeper water. And because of the prolonged drought, the water level has fallen significantly over the last 18 months. So shipping delays create upside in energy prices. And also there are other factors like geopolitical tensions. So we're noticing the ongoing conflict between Russia and Ukraine, and of course the heating conflict between Gaza and Israel. We anticipate these factors to drive up energy prices because more Arab nations are coming to Gaza's assistance in the midst of the attacks by Israel. But I watch geopolitics. I think geopolitics and energy go hand in hand. So persons who have that kind of interest and orientation can look at energy. I think energy is underpriced, and I think tech is overpriced as a group. So those are two domains you can look at.
And you notice that Saudi Arabia and UAE just joined BRICS?
I think BRICS is here to stay.
Listen, yes, Iran as well. So Iran, Saudi Arabia, UAE, along with Egypt and Ethiopia. But those three specifically, major oil producers.
Yeah, so to not bore the viewers, Iran is a sworn enemy of the US. So their beef with the US like Bloods and Crips, they'll never get along. Another way of looking at it is like PNP and JLP. Don't ever expect Iran to side with the US. So what you find is that the enemies of the US are seemingly forming tighter political and economic ties in order to change globalization. So in the last 20 years, globalization was featured a lot of US companies using cheap manufacturing resource bases to produce goods cheaply to sell back to high income countries. We're seeing that change significantly because we're seeing the formation of now more localized and region-based trading blocks and political alliances. So for example, what would have happened with EU is likely to become more prominent, but it will be more region specific. So we're seeing more fragmented trade. We're moving away from the era of having broad-based globalization that we all have become used to. And this is also inflationary because it goes against economies of scale, but it also produces opportunities. So if all these territories are not necessarily using old trade routes, then they'll have to focus more locally, and it will create more local opportunities. So for example, chip manufacturing, more of that will happen on US shores, for argument's sake. That is a boom for the US economy because more production will happen in the US and boost the manufacturing sector in the US. And that could have knock-on effects for the Caribbean region, being neighbors. So there's upside in it, but overall, we expect that to be inflationary, especially within the context of energy, because all these things take energy, and energy is finite, or is a finite resource. So even if we have the same amount of oil refineries, the more exhausted oil becomes, and the further away the oil gets from the surface, is the more expensive it gets to refine and produce. And it means that the cost of oil goes up as it becomes more and more exhausted. So,
but what about having another major oil producer in our region in the mix, which is Guyana?
Yes, that's good. That's good within the context of Guyana seeing supernormal growth, because they are now comparing having, for example, 5 distribution points to having 2 distribution points in a prior period. So that would show growth of multiples and multiples in terms of GDP. And what that will do is modernize Guyana somewhat. In some contexts, you'd say a boom in services being offered, a boom in GDP per capita. So it means that the citizens in Guyana would have more wallet share to actually demand new types of products and services. So Jamaican firms, Trinidadian firms, some Guyanese firms would benefit from this. However, in terms of the oil story, Guyana being on stream is not enough to change the globalized issue of oil running out. I'm an energy bull, but a lot of what I'm saying is medium term. So this has to do with the next 5 to 7 years. We should see a spike in energy prices because energy demand is not going to fall as much as we think. So even though there's a transition to green energy, a lot of the systems that it take that are required to transition to green energy takes fossil fuels to actually enact. So for example, talk about EVs and trying to produce more EVs, getting more EVs on the road. You actually need fossil fuels to produce EVs. And even if we do transition to green energy, we still have not figured out how to get green energy to be as productive as fossil fuels because we built an entire economy or several economies across the world on fossil fuels. So green energy will only be able to do so much and no more. There's a podcast called Macro Voices. You can check it out. It actually speaks about this in far more detail. I think it's a credible source in terms of the bull case for oil.
Sean has a question. So does that translate to RPL and FESCO benefiting from this?
I guess so. I mean, it would be a bull case for RPL and FESCO, but I think that the most upside is from the standpoint of production. So what you find is that companies that control the entire value chain, like ExxonMobil, they are mining the oil, they're refining it, they're producing it, they're distributing it, they have better margins. FESCO's margins are very small. It's less than 5%. So, I mean, I guess there's a case for it, but the real game for FESCO is scale. So they need to build out as many distribution points as possible. And that's capital intensive. So I'm not against that. I think we can make more money, but I just think that there's much bigger opportunity looking at companies that control a wider span of the value chain as opposed to just a distributor with like a 3% margin. And you have to deploy all this capital just to increase your volume. This doesn't work out in comparison. Opportunity cost.
Wow. Thanks so much for the heads up. You had something. Who's that, David?
Yeah, just one thing to add. So one thing that we should also remember, as Julian mentioned, is that because of the Russia-Ukraine crisis, we saw an initial spike in prices then, and then with the price cap that we're seeing by, the G7 countries, you've seen somewhat a retreat in prices because Russian oil is still making its way to the rest of the world. But at the same time, we are seeing other situations that we need to remember. For one, Venezuela is not producing the same amount of capacity in terms of oil. Iran is under the sanctions. So there are different cases or triggers that can increase or decrease prices, because if there was Russian, Iranian, and Venezuelan oil right now, prices would probably be a lot cheaper than they are right now. So the geopolitics that Julian highlighted is a very critical element, towards that who will benefit in terms of the consumer and everything else regarding the price of energy. And then even a FESCO, as Julian pointed out, they are a marketing company for the most part. While they can, supply dealer-owned, dealer-operated gas stations, they're still going to be, within small margins and relying heavily on that increased volume consumption from Jamaica becoming a more developed economy to really scale further. And then Meta, one thing to also remember is that I remember somebody sharing a picture about how Meta was as low as $80 back in, I think, late 2022 when the price crashed and everything. At $89 and we just high as $470 just this week. So it's just pretty interesting to see that at one point in time, the company was dragged by the market, did its staff cuts, planned to do a buyback now, declared its first dividend, and the price has just gone to the moon. So, the US market always gives some insights and lessons that you just tend to appreciate, because the funny thing is almost 1 every 2 persons on the planet uses some Meta products at this point: Instagram, WhatsApp, Facebook. And the reality is the world is still getting more and more connected in a sense, so their growth is still pretty high, and with all the cash they have on their hands, they can do whatever they want. So those are just my 2 cents.
All right. Thanks, David. Thanks, Julian. Great insights this week. Guys,
you're welcome.
Pay attention. Oil prices, something to watch.